Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. This is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any mentions of rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal or tax advisor to be sure a Roth IRA conversion fits into your planning strategies. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.
Obviously, nobody likes to see the market drop, least of all folks saving for retirement. How does the current economic landscape impact the average investor, and what can you do to get through with your nest egg intact?
And now, how to retire with Fuchs Financial.
The main thing for the majority of the listeners out there who are approaching retirement is I don't want to be surprised.
Helping you build, preserve, and manage your wealth.
You got Roth IRAs, you have individual accounts, and finding the right taxable strategy, that's going to be huge for you.
Welcome in to How to Retire with Ben Fuchs.
Welcome in to How to Retire with Ben Fuchs. Hold on, we got breaking news. Breaking news. Ben Fuchs is back, ladies and gentlemen. He's been away for like 3 years.
Listen, I know you're all disappointed. I actually was excited. I'm like, oh, Dina can take over for me. That's great. Apparently, that's not how the deal worked.
No, let's talk about it. So first, you're off to Napa. How was that? Was that nice? Everyone loves Napa, right?
Everyone loves Napa, but listen, like I'm in my 40s. I'm not in my 20s. There was a certain point where it's like, all right, I can't actually drink any more wine. This is it. It's one of those things where like, man, this is great. This is, really they talk about how amazing it is. And I'm like, yeah, whatever. I'd be fine with, a $12 bottle, but
yeah. Exactly.
Yeah, they're like, oh, it's a $150 bottle that we just opened for you. And I'm like, that's great. Somebody else can drink it.
Yeah, right. Ben got the wine in a box, ladies and gentlemen. That's what he was used to. But nothing wrong with wine in a box.
Nothing wrong with wine for those that like it, yeah.
Right. And then you moved on to Fort Myers, which my daughter lives down there. You almost got caught in that storm, didn't you?
So we were there. I actually recorded a video for my clients from that storm. So I had the hurricane going on in the background. That was fun. But no, we were there for my parents' 50th wedding anniversary.
Nice. So that's amazing. Congratulations to them.
So our 5 went down. My brother and his clan of 4, my sister and her clan of 6. Nice. Aunt and uncle, it was great.
Great. Yeah, that's great. And I love Fort Myers. I lived down there for a year, and it's a shame what happened to the beach during the hurricane a couple of years ago. But they're slowly building back up. And then you went to Nantucket, which reminds me, there's an old limerick. There was a man from Nantucket. No, I can't say that one.
No, listen, first of all, it was Narragansett.
I thought it was Nantucket.
Yeah, but second of all, I'm glad that you didn't continue on that limerick. I think the world was better.
So it was Narragansett, which is in Massachusetts, from what I recall, based from geography history. Yeah.
I'm not going to give you a hard time, Gary. It was Rhode Island. Anyway.
Oh, wow. Boy, am I messed up.
That's okay. Listen, it's been a long time since you've been on the East Coast. No, so every year. So apparently, my wife's aunt and uncle have been going to Narragansett since before my wife was born, since before, forever. So it's been this tradition, and it's fun, and it's great. And also, by the way, I can't tell you how happy I am to be back in my own bed.
Exactly. Yeah. So I'm as far as here's my history grade here. Yeah, that's what I get for history. Narragansett. Okay, I got it.
One might even call that geography, Gary. Not that I'm going to correct you again, but
exactly. Yeah. Well,
don't give you a hard time.
Anyway, I'll learn from you. I learned a lot so far.
Listen, for the people that obviously can't see us because this is a radio show, Gary did just try to punch me, so I was able to dodge away. I can still duck and weave a little bit.
Nice job, though. I appreciate that. All right. Well, we probably like I said, Gina filled in and she did a great job. Yeah. And she really had fun. I know she was a little nervous at first. We walked her through the show, and like I said off air, she's a lot better looking than you.
Well, thank you. No, I mean, first of all, I respectfully agree with you. A. B, I had no concerns at all that she would be excellent, and as it turns out, she was.
Yeah, absolutely. So anytime you want to go on vacation for a while, just let me know, and Gina's set to go. She's in the bullpen warming up, as they say in baseball. All right, here we go. All right, so let's get to the show now. Fretting over your nest egg in the wake of a largely negative economic forecast, well, can be relatable, really won't do much to except add stress to your life and knee-jerk emotional responses. So let's talk about that. A couple of points to get to. Keep calm and invest on. It should be on a T-shirt. Keep calm and invest on, Ben.
Probably is. We might trademark that later. But look, market fluctuations are normal. If you're years away from retirement, a market downturn is just a temporary setback. And even though it's been said a million times before, it is a buying opportunity for your retirement funds. When the market goes down, you buy in. Why? Because if you have 15 years before you're going to retire, you can let that money continue to grow, continue to invest, and put as much in as you can comfortably, and that's going to help you long term. Don't sell out of fear. Again, fluctuations are normal. Panic selling can lead to missed gains and unnecessary tax consequences. I had emails from people saying, "Hey, Ben, get rid of all of my market stuff. And I said, listen, that's your money. I'll do whatever you want to do, because ultimately it is your decision. However, here is my strong recommendation. Don't. We planned for this. We have a place to pull money from. If the market goes bad, we can survive years of a downturn. Don't let this little blip affect you." And thank goodness they actually listened to me. It's weird how people will pay me to help them with their investment advice and then say, "No, I want to do it on my own." Listen. The reason that you have me is so that I can help you through times like these, so we don't panic sell, so we don't jump out because the market gets tough. And listen, the closer you are to retirement, the more you realize that you're relying on this money, the more important it is for you to maintain that balance. So I understand that. And listen, the most important thing from our keep calm and invest on bullet point here is have a plan. A solid retirement plan helps you stay on track even during market downturns, which is why so many of my clients were not that worried when the market took a hit.
Yeah, it took a hit a couple of weeks ago. I think it was on a Monday. It was down like 1,000 points. And by the end of the week, it pretty much had recovered anyway. But did you get a lot of calls, a lot of people panicking, or no?
Yeah, I mean, I think it's pretty normal. You had a couple days where you had some really significant drops, and it was like, the worst drop since whatever they say, 2022 or 2021. I mean, it's like, oh, wow, 2 whole years. But,
I know.
but it's tough when you see what's called correction territory, when you see something take this more than 10% hit. Listen. Statistically, that happens about every other year. It is normal. It is something that needs to be accounted for in your retirement plan. And if you got really anxious, now that things have recovered, now is the time to take action and make sure that you are protected for when it is a prolonged downturn. Because we know that it's not going to just bounce back right away every time.
All right, let's talk about this. Tips for those who are nearing retirement, Ben.
All right. So if you're close to retirement and you're worried about your investments, you need to talk to a financial advisor. They can help you adjust your portfolio to minimize risk without sacrificing all of that potential growth. Look, everything is somewhat of a seesaw, right? If you're going to go for more safety, you give up some of that growth. If you're going to go for more growth, you're giving up a fair amount of safety. What's important is to understand that it's not just one or the other for all of your money. You can have these bucketed strategies that I think every financial advisor and their mother and their children and their grandparents talk about, having different buckets of money. And the reason that so many people talk about it is because it's effective. And so when you have something like that, you need to have a place where you're getting that long-term growth, but also a place to rely on when the market crashes. Remember, again, market drops are common. Historically, the S&P 500 experiences multiple drops of 5% or more each year. Don't let fear cause you to miss out on the long-term benefits of investing. If we look at the S&P 500 in 2008, I think it was around 13-ish hundred. And it dropped to as low as around 800, ballpark, right? Don't have the figures in front of me. And if we fast forward today, we're over 5,000. So 14 years later, that thing has quadrupled, right? And then some. So if you go year to year, it's terrifying. We can't tell you what's going to happen tomorrow. We can't tell you what's going to happen next year or 2 years from now. But like insurance companies, and I know we're in Connecticut, so let's talk about insurance companies. They live off of the law of large numbers. And the longer outcome that you have, the more time, the more runway that you have before retirement, the more important it is to say, look, I'm going for long term here. I have some money that I'm not going to need for 10 or 15 years. Great. That's going to be my risk money. The money that you need to pay your mortgage obviously shouldn't be in the stock market. So again, those are your bucketed strategies, but that's what we'll figure out for you.
He's letting the clock run out on his Social Security to age 70 for maximum benefits. And here comes the Roth conversion. He's locked in for income for life. He's got some outstanding coaching with that annuity plan. He's created his own pension as well, and it looks like he's going to go all the way.
Play your best retirement game. Call Ben Fuchs at Fuchs Financial, 800-380-8985, 800-380-8985.
All right, today we're drawing inspiration from Stephen Covey's timeless classic, The 7 Habits of Highly Effective People, but put a little spin on it. We're applying these powerful habits to retirement planning, so let's dive in. Habit number 1, Ben, be proactive.
Yeah, being proactive means taking charge of your financial future today. It's never too early or too late to get started. The key is to be intentional. So retirement isn't something that just happens. It's something that you need to plan for. Start by assessing your current financial situation with a retirement professional. Identify your retirement goals. Create a plan to achieve those goals and control what you can control. Start by maximizing your contributions to retirement accounts like 401k or IRAs, and regularly review your investments with your financial professional. Also, avoid robo-advisors and AI to accomplish your goals. For us, I think that the technology is not quite there yet when it comes to retirement planning from robo or AI. At some point, it might be, and my job will be irrelevant, but until that day, give us a call. Listen, I think a lot of people, everybody's in a different phase in their life, right? Some people are at that point where they're getting ready to retire. They've got 5, 6, 7, 8 years left. Their kids are done with college. All of a sudden, they have more money now from their paycheck that they can actually keep and use to save. There's a lot of value to that. So that's when you really want to start maximizing your 401k and maximizing your retirement. Other people have been really, really good savers early on, and now one spouse is retired. They should not necessarily be maximizing their 401k. They might not want to put anything other than the company match into the 401k. It's a little bit different and unique for everyone, and we see a lot of unique scenarios based on each client, which is why we need to have these conversations.
You know, Ben, a lot of folks when they're younger and they're in the accumulation phase might use a robo-advisor, but it gets real tricky during the distribution phase. Would you ever, early on, is it okay to use a robo? Let's say a guy's 20 years old and wants to get started at 25. Would that be okay?
So there are some things that I don't like about robo-advisors. So the whole idea is it's like low cost, and a lot of those are put on by different financial institutions, by your, we'll call them big box investment companies.
Sure, right.
And surprise of all surprises, that robo-advisors want you to use all of that one company's funds, right?
What a surprise, really.
Right. And so it's interesting, like, hey, this doesn't cost you a lot, but some of the funds that they put you in might be more expensive. And so that robo-advisor that doesn't cost very much actually ends up costing something. There's a reality for a lot of people that if you're just going to be long-term growth investing in your 30s and 40s, I don't have a problem with you simply using indexes. I don't think that we need to say that indexes are bad. They're not. They have a history of working well.
Sure.
And frankly, I'm in my early 40s. It is what I use for a lot of what I have. Now, I have a lot of individual stocks I like to pick on occasion. That's obviously, part of what I do. But for the vast majority of people, I think that you're going to actually get more value just by using some of these indexes over the long haul. And that's what we've seen. And so I don't feel like anybody needs to pay extra money for those robo-advisors because of that.
No.
Now, when you get to retirement, it's a different ballgame. You can't take the swings, right? If market goes down by 30% like it did during COVID or during 2008 or 2001 or 94 or 87, all those different time periods when we had these massive drops, it's a different ballgame. You might not know how to react, and it might take a long time for the market to come back. We've seen drops during COVID where it fell by 33%, and by the end of the year, it was higher than when it started.
Right.
Okay. That's one example. But also keep in mind, from 2000 to 2002, it took over 900 days for the market to get back to even. Now, can you handle that 3-year period of a market being down with your retirement? I don't know if you can do that. And so that's a separate conversation that it has to be planned for.
Good advice, Ben. Habit number 2, begin with the end in mind.
Yeah, sit down, spend time with your spouse to discuss what your individual goals are and your family goals in retirement. I can't tell you how many times I ask somebody, what's on the bucket list, and they look at each other like, I don't know, well, which is fine. Look, I'm not giving you a hard time. I'm just saying, it would be nice if y'all talk to each other. No disrespect, I know that's hard, but it would be nice if y'all talk to each other ahead of time.
And once in a while.
Yeah, hey, what do we want to do? Let's have that conversation. Do some retirement rehearsals. If you want to travel Route 66 front to back, then rent an RV for a week and see how you like it. Because if you start driving one day and you're like, my leg hurts, I don't want to do this anymore, well, that's kind of the end of it, right?
Yes.
And if starting a cottage business is your goal, do you have some savings put aside to start production? By defining your vision, you can reverse engineer your financial plan to make it a reality. I remember there was a client of mine 7-8 years ago who her parents had passed away. It was awful. It was sudden. She inherited a fair amount of money, and she wanted to start a business. And with that, right, with starting that business, we did the same thing. We did the same exercise. I said, all right, well, you have a space that you want to rent. You think it's wonderful. How much does that cost? Okay, great. So we put that up there, right? This is business planning 101. What's the cost of that space? What's the cost of the employee that you want to hire? What's the cost of all the materials that you need for that business? Great. Okay, cool. So here are your ongoing costs. Forget about the one-time upfront costs and stuff, but like the ongoing costs, how much do you need to sell in order to break even? And once we figured that out, and the amount of time that she would have to spend for this business where she would theoretically have more control, she realized that it was absolutely 100% not worth it.
Right.
And so it's so important to, begin with that end in mind.
3 is put first things first, Ben.
Yeah, work on a budget with your professional advisor, right? Commit to prioritizing your long-term financial health over short-term wants. Pay down debt today where appropriate for peace of mind tomorrow, and automate your savings. If we can do those things, you're going to put yourself in a much better position. Now, I don't necessarily think that you should always give up the short-term wants. I think that there's some balance there, but keep that in mind.
All right. How about this one? Habit number 4, think win-win. It's an old expression. It's win-win. What does that even mean?
Yeah, a win for you and a win for your entire family. Assemble your financial legacy documents with some direction from your advisor. But I think a win-win for me is, can I win tomorrow and win today, right? I think it's so hard. We're either sacrificing today so that we can live better tomorrow, or sacrificing tomorrow so that we can live better today. I think the goal with somebody coming into our company to meet with one of our advisors is to figure out how you can spend money now and comfortably spend money later, so that you can find the right balance between being, we don't want you to be retirement rich and life poor, or the opposite, right? And so what we've seen, everything. I've seen all of it. I've seen both sides of the spectrum. But the important thing that we can do is help you figure out where to put your money, how much you can live for now, while also being very secure with your financial future.
All right. How about the next one? Habit number 5, seek first to understand, then to be understood.
Yeah. Ask questions. Do your research. Here's the deal. A lot of people come to us and they say, look, I don't know really what I want or what I need. Can you help me? And the answer is yes. We're happy to. But I will also say that if you are looking for an advisor and you want to talk to 3 or 4 different advisors, which is fine, I think you want to figure out what you want to accomplish from the advisor before going to interview them. Are you trying to get as much possible growth as you can without worrying about risk? Okay, great. You want more of a hedge fund style. Or do you want to get consistent monthly predictable income and not have everything be thrown into an annuity? Okay, great. That's when you come to us. And if you want everything totally and completely safe and you just want annuities and you just want that, which, by the way, is a style that I firmly disagree with. I feel like you might be doing the wrong thing. But that's a conversation, right? We use annuities in our practice where appropriate. We don't say no to any style of investment. It's important to look at everything. However, we also understand that there are some, we need to have balance for long-term growth.
Right. And part of your fiduciary responsibilities is to be honest with people and be very transparent, Ben. And you're just not going to tell them what they want to hear. And that's not right. Am I right?
Yeah, I mean, it's part of our responsibility as an advisor, which brings us to habit 6, right? We want to synergize, right? Create a balanced and resilient financial plan, including diversity, safety, and growth. And if we can do those things, that's incredibly important. Now we're starting to set everything up. And the last piece is habit number 7, sharpening the saw. right? Retirement planning is an ongoing process, not a one-time event. If you're meeting with your advisor once every 2 or 3 years, that's just not good enough. We know that your life has changed. You know that your life has changed over time and will continue to change and evolve as things comes up, as health concerns come up, as parents might get sick, as you have to have maybe your kids or your parents move into, that changes the calculus, it changes what you need for income. All those things are totally and uniquely different. So, habit of continuous improvement keeps your financial plan sharp. Ultimately, what we can do is help you develop that financial plan, figure out what your goalposts are, help you seek first to understand, create win-wins for your retirement plan, begin with the end in mind. What kind of a retirement do you want to live? How much do you want to spend in retirement? Let's focus on the goals and what you want to accomplish. And then from there, we can help you, whether it's figuring out when to take Social Security, how to generate the right kind of income for your retirement plan, right taxes, investment plan, estate planning. All of that is incredibly important.
We believe in better. A better way to invest, a better way to serve you, and a better result. We can help you determine how much risk you're taking, red flags that could be potential problems for you, how much you are paying in fees or commissions, potential tax liability, or even how to address Social Security. Call Ben Fuchs at Fuchs Financial, proudly serving all of Connecticut. Call today, 800-380-8985. 800-380-8985.
Well, you see a lot of bad stories about recession and how that works, and it's true that things might be bad, but let's go a step further. Let's talk about the worst market crash in American history and what every investor can learn from this. Of course, we're talking about Black Tuesday, the Wall Street crash of 1929. No, Ben, I wasn't around for that. I know you're going to say something. Yeah, I knew. I could just see that you're about to say that I was there.
He had to sell his Model T, people. It was a rough time, but
yeah, I did have to sell my Model T. Okay, the dip was deadly and absolutely destroyed people. Markets lost $14 billion, and if you watch the movie A Wonderful Life, yeah, there was a run on the bank. Stuff like that really happened. All right, the Dow Jones average lost 25% in 2 days. Now, if you're listening, you probably remember the crash of 2008. Yeah, that one I do remember. Well, the lessons learned from that crash are largely the same as lessons learned from Black Tuesday. So here are 7 things from these crashes you got to remember for retirement planning. How about the first one? The dangers of speculation, Ben.
Don't get greedy. So excessive speculation. Many investors engage in speculative trading, buying stocks on margin, borrowed money. Margin means borrowed money, which created an unsustainable bubble. And then margin calls. When stock prices fell, margin calls forced investors to sell at a loss, exacerbating the market decline. So let's keep this in mind. This is the most important one. How many people have oh, NVIDIA, I see it going up like crazy, I need to buy it. Okay, listen, I'm not saying it's not a great stock, but I'm also saying that it can take some pretty big hits, just like anything else. And if we look at the last couple of weeks, we've seen it go significantly up, significantly down, significantly back up. We're trying to speculate and time something. Okay, again, for your mindset, I'm only buying the stock if I'm going to hold on to it for at least 5 years. And if I'm not going to do that, then there's no value whatsoever. Then I'm doing the wrong thing. I am not somebody that's here to help out a day trader. If you do that, you're more likely to go with, your different advisor, right? This is retirement planning. We don't want to get overly speculative for that piece because historically, 98% of the people miss the mark.
All right. How about this one, Ben? Investment education.
Right. Financial literacy. The importance of financial literacy and understanding investment principles cannot be overstated. Educated investors are better equipped to make informed decisions, along with continual learning. Staying informed about market trends, economic developments, and investment strategy is vital for adapting to changing conditions. I can't tell you, when I was taking the CPWA exam, the Certified Private Wealth Advisor Professional exam, there were so many different biases, behavioral biases that people fall in line with when it comes to investing. If they work for a company, they feel like they understand that company better than other people do, and so they're going to have more of their money in that stock. And historically, that just does not work out for them. So which brings us to our next point, which is the importance of diversification. Lack of diversification, investors heavily concentrated in the stock market suffered severe losses. Diversifying investments across different asset classes can help mitigate your risk. Asset allocation, Balancing investments among stocks, bonds, real estate, and other assets reduces your vulnerability to market crashes. I think ultimately at this stage in the game, when you get to your mid to late 50s, when you get to your early 60s, you want to be able to balance and not be vulnerable to a market crash. We don't want the stock market crashing to affect the way that you live now or in the future. And if that is the case, then it's a sign that you could make a change.
So we went through the dangers of speculation, investment education, and the importance of diversification, need for liquidity, Ben. Let's talk about that a little bit.
Yeah. Cash reserves. So many investors are over-leveraged and lack sufficient liquidity to meet margin calls or to cover their losses. Maintaining cash reserves and liquid assets provides a buffer during market downturns. Emergency funds. I can't stress this enough. Having an emergency fund can prevent the need to liquidate investments at a loss. Listen, we know things are going to come up. We know that emergencies are just going to happen. You're going to need new tires. You're going to need new brakes. You might need a new car. Who knows? Your kid might say, I need $15,000. And you're like, yeah, no, I have to give that to you for whatever reason or more, right? These things just happen. And if you don't have the money in an emergency fund, you typically have to go in debt to get it. And you don't want to put that stuff on your credit card. You don't want to take a line of credit out on the home. If you save for it in advance and you plan for an emergency, you plan for these cash reserves, it puts you in a much better position to survive retirement, to survive your general working life in general. But you have to take the time, be disciplined, and not spend all the money at once. Save up for it instead of just buying it and putting it on credit.
You mean paying for an expensive lawyer for your kid? That can happen, you know.
I've heard a couple stories, my
friend. It has happened, Ben. I got to tell you.
In case you're wondering if this is some kind of an inside joke, no. Luckily, my kids are all 10 or younger, so I have not had the pleasure of paying for a lawyer.
It's not you, sir. It's me.
You want to talk about it, Gary? This is an open forum. This is a safe place. I can tell you that nothing will leave this radio station.
It's too painful. It happened a number of years ago, and it's all good now. But, yeah, there was a time, my friend, and that's why you need that emergency fund. Yeah, absolutely.
You can't see it, people, but I did just knock on some wood.
Yeah, exactly. Yeah, I'm knocking on some wood, too, so it never happens again. Understanding risk. We talk about risk a lot on the show because it warrants it.
Yeah, I mean, I feel like it's one of those things we never talk about. Risk, right? Oh, the market could crash. Really, Ben? What a shocker. Yeah, look, risk assessment. Investors underestimated the risk of a market downturn and the potential for severe losses. You know, think about the roaring 20s. Everything was going up, up, up. Everything was great. Think about the 90s, right? If you look at the 90s, you had that crazy run-up where you had like 4 or 5 years before the dot-com bubble where everything went up by like 20, 25% a year. It was incredible. And then the market went down almost 46%, give or take, over that 3-year period, you know, from 2000, 2001, 2002. Listen, people get comfortable. One of the things that I look at all the time is a thing called the VIX, the Volatility Index, and it's another name for that is the fear gauge. How afraid are people right now? And if we looked like 4 to 5 weeks ago, it was at its historical, like one of the lowest points that it had been. So just a little history, like the VIX, the fear gauge is typically like at 18, 19, right? And during COVID, it went up to like, I don't know, 60 something, crazy. But the last couple of weeks, it was like 11, 12. And then things started hitting, things started selling. All of a sudden, big sell-offs happened. VIX shot up to like 30 and 25, and that's usually like sky is falling territory. And again, you know, beginning of this week, it was right around 14, 15. I mean, it's incredible how complacent people get and how quickly they get complacent and just assume things will go up. So understanding risk, avoiding over leverage, incredible pieces.
All right, a couple more to get to. Psychological preparedness, Ben. What do we mean by that?
Yeah, so we'll put this under the category of emotional discipline. Panic selling and herd behavior contributed to the crash. Maintaining emotional discipline and avoiding impulsive decisions can help navigate market volatility. What does all that mean, Ben? That means don't sell just because everybody else is selling. Don't jump ship just because your neighbor's doing it, because your friend at the water cooler said that now's the time to get out. Jump, jump, jump. Again, 98%, 97%, I forget exactly what the statistic is, but 97% of stock pickers are just flat out wrong. So if you have conviction in something and you think something's going to hold or come back, then don't sell. How many people sold NVIDIA when it went down by 20% a week or two ago, right? And then it popped back up. Oh, wow. Okay, great. Again, I'm using that because it's probably one of the most talked about stocks right now. And it will continue to be because it is leading a trend and it makes sense and there's value to it. And I don't have a problem with it. And we own it in our portfolios, by the way. Let that be known. But you have to have a long-term perspective, and focusing on long-term investment goals rather than short-term market movements helps maintain a steady course during downturns.
All right. How about the final one? A couple of minutes left, Ben. Impact of macroeconomic factors. What do we mean by that?
Yeah, this is one of those things where historically advisors just do it better. Economic awareness. Investors need to be aware of broader economic conditions and their potential impact on the market. So economic imbalances such as excessive debt, uneven growth can lead to market instability. Oh, interest rates. I think we've seen that impact the market. How many times has the Fed sneezed and all of a sudden the market went down by 2% or up by 3%? It is those little movements that you really have to be patient and pay attention to. But it's not just that. It's the little things. It's the jobs reports. It's all of those pieces that contribute to these factors. Global interconnections. Understanding the interconnectedness of global markets and economies helps in assessing potential risks and opportunities.
Do you ever feel like you're fighting for financial knowledge? Don't let bad advice be a punch in the gut to your retirement. Take advantage of a complimentary, no-cost, no-obligation consultation with a local, trusted financial coach.
Call Ben Fuchs and the team at Fuchs Financial, 800-380-8985. That's 800-380-8985.
Now, we've been hearing about the Social Security number data breach in the news. Can you give us a brief rundown of what happened and why it's such a big deal? Let's talk about that a little bit. It's a little frightening.
Yeah, a recent data breach compromised sensitive Social Security number stuff. It was a massive data breach, and it could affect, I think the number that I read somewhere from the National Public Data was 2.9 billion records, including names and addresses, Social Security numbers, and even relatives going back like 3 decades. So this is not a small thing. The impact is that it could lead to identity theft and fraud, which is particularly concerning for retirees and those saving for retirement as it affects their financial security.
All right, so Chris Como spoke with cybersecurity expert Rico Danielson on News Nation about the impact this might have on your finances. Here's what he had to say. I'll get your comments on the other side, Ben.
How screwed am I, Rico, right now?
You're not that screwed, but we are all pretty much going to get hit on this one. Unfortunately, a cyber threat acting group, a very big hacktivist group, teamed up with other activist groups and threat acting groups and exfiltrated, 2.9 billion data points right now.
The Social Security part matters. How compromised are Americans by this hack with that information?
So what I would say is go ahead and presume that because of this and another breach that happened, if you're in this one or that one, your Social Security is pretty much gone and the threat acting group has it and it's for sale on the dark web. If not, this breach right here will actually prove that your Social Security more likely is going to be sold as well. So now it's time to buckle down, bare knuckle down, and actually do some proactive things about it.
Rico, you're way too calm right now.
Yeah. So first of all, what can you do about it, Ben? What can you do?
Yeah, this is tough for people that are in the process of buying a car or buying a house, but one of the best things that you can do is a credit freeze, which limits access to your credit reports. And I think that is the number one thing that most people do. I think a lot of retirees are not buying a car tomorrow. They don't need to worry about that. Right now, if you're not doing anything, especially at this time, freeze your credit. Let nobody buy anything. You can unfreeze it later. It's not like it's a permanent thing. It's not like it's gone forever. But that might be the most impactful thing that you can do. I'm sure there's a lot of companies out there that want to monitor things and would love to get your business right now because wouldn't that be great? But if you just freeze it, they can't do anything with it until you unfreeze it when you need something down the road.
All right. So you actually can freeze your credit. Is that right?
Oh, yes, absolutely.
All right. I had no idea. All right, Ben, we have a couple of questions to get to from our listeners. Let's talk to Ron in Rocky Hill. I want to leave a reasonable amount of money to my kids, but I don't want to pinch pennies throughout my entire retirement, to make that happen. Do you have any tips in this area? What do you have for Ron in Rocky Hill?
Yeah, Ron, so, typically the first thing that people do when they want to leave a lot of money behind is that they'll buy a life insurance policy that is going to be long-lasting, right? You don't want to get one of those 10, 20, or 30-year terms. You want to get like a whole life, universal life policy that will last until like 120. That's great. Well, what if you're like in your late 50s, early 60s? What if you have heart problems? What if you are on high cholesterol medications, or, the stuff that most people are on anyway? Well, then you don't want to do that, right? Then it becomes prohibitive to buy these long-term life insurance contracts. So you want to look at the way that your investments are allocated. If you are being sold an annuity that will generate income, and you have a lot of your retirement investments going into that annuity that's going to generate monthly income. If that's the case, you may want to switch gears, right? You may not want to do that, because really what those annuities are great for is getting income for the rest of your life. What they are not great for is leaving a legacy. Typically the goal is to have the money in that annuity go down to absolutely nothing and have you continue getting those monthly payments. And that's one strategy that works for a lot of people. That would be the camp of people that say they want to bounce their last check. Again, you still shouldn't have all of your money in that type of investment, but it is an example. So really what you want to focus on are investments that, this is somewhat self-serving, you're welcome, Ron, but investments that generate a principal, generate income, and maintain your principal. Our company seeks to generate about 8% a year after our fees. Thank you very much. Sometimes we get more, sometimes we get less, but that is the ultimate goal. And in so doing, you can maintain your principal. You can take the interest that's earned off of that money and leave the principal alone. That way you don't have to pull from it. And that way you can take your monthly income, not pinch pennies, and still maintain the principal for the next generation.
Looks like we got time for one more question, Ben. Brett in Bolton. I was terminated by my employer. I know what that's like. I've been fired 5 times in my career, Ben.
All of them were crazy.
Yeah, only once was it my fault. Someday we'll talk about that when we have more time. Anyway, get this. The paperwork they sent me was a 10% penalty for early 401k withdrawal would be waived for payments made after separation of service after you turn 55 during that year. Now, do I need to roll the 401k over to an IRA first and then do the payments to avoid the penalty? I don't understand this, Ben. Can you clarify this for us? I don't get this.
Yeah, I got you. So there's a rule that a lot of people don't really know, and it's like a 55-year rule. I forget what they call it, maybe the rule of 55. You never know how they actually name these things. But ultimately what it means is that if you are separated from service, if you leave in the year that you turn 55, there is no 10% penalty if you take money from your 401k at that point. Now, if you roll it into an IRA and then begin taking payments, you actually will incur that penalty. So we have a lot of clients that end up retiring at 56, 57, 58 years old that want us to manage their money and roll it into an IRA that we can manage for them. And we actually tell them, no, don't do that, or don't do that with all of the money. Leave enough in the 401k so that you're very, very comfortable and have a backup plan. That way you can pull money from that 401k to maintain your lifestyle without having to take a penalty. If you roll it into the IRA and then begin taking payments, you will incur that 10% penalty. So it is one of those rules that a lot of people don't quite understand because it's not like often talked about. I think a lot of employers don't want you to know that. They don't want you to know that you can actually retire earlier and take money penalty free, because why would they want that information to be public? They want you to continue working for them for as long as you possibly can. But that's why it's so important to talk to an advisor. I mean, there's just no question that we know things that, well, hopefully, if you're a good advisor, right, and this is all that you do for work, that you know things that other people don't, that this is the world that we live in. And so because of that, we're very comfortable helping you navigate retirement, finding ways to retire. There's also other things that you can do. There's a thing called a 72T or SEPP, which is separate equal periodic payments, where if like you're 52 years old and you want to retire and all of your money's in an IRA, you can actually generate separate equal periodic payments so that you can get the exact same monthly payments for life. I mean, not for life, or until you turn 59 and a half, or you've worked at least 5 years, whatever's longer, and get that money and take it out of the IRA without a penalty. There are different ways to navigate early retirement. But you have to jump through hoops. You have to understand that there are, you might pay more for an accountant for those couple of years because it is one of those things that is tricky. But that's what we're here for, to help you figure out ways that you can retire. I mean, look, we talk about a couple things. And then just going back to the Social Security freeze, because I wanted to talk about the Social Security breach. That information that's out there is terrifying. I mean, again, they talk about 2.9 billion data points. That is a tremendous amount of data out there that could be sold on the dark web. And so again, it's something I would definitely encourage you to freeze your credit. It is free. It does not cost anything to do that. We don't benefit at all from that as financial advisors. It doesn't help me at all. But for you, it's something that could give you peace of mind. And right now, it is a good and smart time to take action to do that. And if something comes up where you need to change that, you have the ability to. But nobody can really take your credit without you freezing it. That's my understanding, and that would be, I would say, the recommendation from the majority of people over time.
All right, Ben, up against the clock. Final thoughts before we wrap up today's show.
Yeah, we've talked about a lot of great stuff, right? We've talked about 7 habits for an effective retirement. We've talked about mistakes that people made in the Great Depression and Great Recession of 2008. Ultimately, we're here so that you don't have to worry about that stuff. If you want to educate yourself, this is a great way to do it. But if you want someone else to take care of the stuff for you, that's what we're here for. We're here to take that burden off of your mind, off of your shoulders, so that we can carry that for you and make sure that you're doing all the right stuff for retirement. Look, the majority of people that I talk to just want to be able to maintain their paycheck when they retire. How do they do that? Are they just going to sell chunks of mutual funds and take them out every month or every quarter to give their lifestyle? Or are they going to set up a consistent payout plan? Do we want the stock market going down by 30% or even 10% to affect the way that we live and affect the way that we feel? I don't want any of my clients to have anxiety because the market crashed. I want them to know that no matter what happens with the stock market, they're going to be just fine. If we can do that and we can provide that peace of mind, we don't need to go for greed. We don't need to try and get 20 or 30% or 60 or 80% every year, because we know that if we go for that, it can also go in the opposite direction. And so we want to make sure that we're consistent, that we're predictable, that we're doing exactly what we say that we're doing, and that you can go on vacation even if the market goes down.
This is your chance to benefit from the How to Retire Blueprint. Call right now. We still have a limited number of availabilities on our calendar. They do go quickly, no cost or no obligation. Claim your spot right now, because nothing changes until you do that. 800-380-8985. Like I always like to say, you deserve a more confident plan to retire. You want to be stress-free, peace of mind. But Ben and his team cannot do anything unless you call that number, 800-380-8985. The show has flown right on by. I'd like to thank everyone for listening. I hope you found the information we presented helpful. Look forward to all of you being back next week. We'll have new topics and new questions right here on How to Retire with Ben Fuchs. Ben, seriously, it's great to have you back. I enjoyed the show.
Yeah, and I'm sorry you have to look at me instead of Jada, but I appreciate you too, Gary.
Investment advisory services are offered through Foundations Investment Advisors, LLC, hereafter known as Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment, opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor situation is different, and ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio of securities, or investment strategy is suitable for any person. No legal or tax advice is provided. Please review your retirement, tax, and legacy planning strategies with a legal or tax professional before transacting or implementing any strategy discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, or any U.S. government agency. If applicable, we do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. All rights reserved.